Roth conversions. So we were talking about what if you did a conversion, and we talked about this. You could do less or more subject to your margin in your tax brackets. What I mean by margin, let's say in the 22% tax bracket, your household income is $100,000. That top of the 22% tax bracket is $178,000. Plus, you've getting a standard deduction for both of you. What's that? Around $20K?
Yep, 25.
Yeah, so that's almost $100,000 margin right there. But let's say, and you got a big old fat tax infested IRA, 401K. Yeah, Jude's liking that. Yeah, tax infested account, and you're kind of saying, well, you could shift as much as $100,000, but there's a tax bill on that. But I talked earlier. What if you do $33,000 for 3 years in a row? So we'll just keep it at that simple math. But you could end up doing less. You might say, well, I'm in the 12% bracket. My income was 60 after deduction, so it gives you about a 23 mark. You could convert 20,000 in that case. But earlier I was talking about 33,000 a year for 3 years, and that gets you to 100,000. And in 30 years, that could compound at 7.2% hypothetically to $800,000, and you only had to pay tax on 100,000. You made it simpler because you said on the break, what's the worst tax rate could be on that 33,000?
Well, we were talking about most folks are in the 20s. And, from doing a lot of returns, most folks, average a little small refund, either, some child tax credits or something like that. And, say a $3,000 refund, if it cost you $6,000, $8,000 for this conversion, now you're only out $4,000 or $5,000. And if you plan it, the beauty of that is you could go up on your withholdings a little bit throughout the year, cost you even less. And so it comes to the fact that it's almost paid for anyway when you do it in small increments like what you're talking about.
That's one reason to look at the tax efficiency report. You provide one, we provide one, and look forward to kind of see what would be the impact of that. Plan for it. Don't just on a whim, because when you do a Roth conversion, and I need to explain this. You used to could change your mind, but a few years they pulled that off the table. It was called recharacterization. There's really no such thing anymore, because once you do a Roth conversion, it's done. So you need to look to what that tax bill is going to be, because I had people recharacterize like, and it was clear of what the bill's going to be, but when it actually shows up, it's like, oh my God, I don't want to do it now. Okay. Well, now when you do it, you have to, you can't change your mind. You can't have regrets. It's kind of like buying that F-150, driving it off the lot. And the wife says, why did you do that? Take it back. I don't know that that's such an easy thing to take that truck back. Okay. With that said, but you gave me a number. If we do 33,000, when you kind of look at what's the tax bill, so they don't have any deductions for most people, about $6,500 is what you said.
Correct.
We're kind of good there. Worst case, you said worst case max tax bracket about $11K.
Yes.
Okay. And if you can pay that, now you've got 33,000, and for most people are probably, most of the population are somewhere between 12 to 24%. Most taxpayers are in that range that pay taxes. Not everybody pays taxes.
And most taxpayers get a little small refund.
Yes. Awesome. So it's not that bad of a hit. Then you have, and you have that 33,000 go into an account, and it can start working. And then you do it 2 years in a row, you've got 100,000 there. And what if you didn't do any more thereafter? It just didn't work right for you, because now you're in retirement, let's say, and you just don't have the room in your budget. But we can let that money compound. And that's the magic of it, is being able to put it to work and leave it alone for a good period of years. And if you could do so for 20 years, that 100,000 at 7.2% goes to 400,000. Here's one of the other things regarding estate planning is when both of you die in the household, the husband and wife, as an example, and you're leaving it to your kids, they have to spend the money down in 10 years. These IRAs, these tax-infested accounts that you have, they have to spend it down in 10 years. That's the rule going forward. If it's a Roth, so go back, it's a traditional account. Most of you are leaving behind tax-infested accounts, so they got to spend it down. They got to pay taxes. It's got to go on top of their income and such. It's not optional. It has to be done during the 10 years, finished out during year 10. So you're impacting and meaning you're going to cause that money to be taxed even more in the future, doing a good thing by leaving it behind. But what if a chunk of that became that Roth and it grew for 30 years? You're leaving behind $800,000. Yeah, they have to spend it down, but does it go on the 1040, Jude?
No, it does not.
It does not ever go on the 1040. Roth is kind of this magical thing that we have. Couple rules. That Roth account has to be alive for 5 years for you to take money out tax-free, and you've got to be beyond age 59 and a half. Couple simple things, no biggie, because we want it to grow. Any other thoughts on tax savings?
So the main thing for us is, to keep up with your taxes and your bookkeeping on a regular basis if you have a small business. It's just helpful to have all that pulled together where we can take a look at it on a regular basis and advise and really protect you from, like you say, making any tax missteps. Sometimes, like you were alluding to, Gregory, people they get this big thing of I'm gonna do something, and then they do it immediately without consulting with an advisor, and turns into a mistake. So, proper planning works.
Yeah, I think it's really important to reach out and get some guidance and help, especially when you're coming into money. Don't shortcut it and have Uncle Sam sending you those letters later.